What if the biggest reason people fail to reach their retirement goals has nothing to do with bad investments and everything to do with perfectly human reactions at the worst possible moments? What if the real danger to your retirement plan is not the market itself, but what you feel compelled to do when fear, greed, and uncertainty take over? This question matters because most investors do not underperform the market. They underperform their own investments, and that gap is almost always caused by behavior. Fear, panic, greed, and headlines influence financial decisions in subtle ways that most people do not notice until after the damage is done. The change rarely happens all at once. It starts slowly. As markets rise, comfort grows. Risk stops feeling risky. Recent success begins to feel permanent, and people naturally adjust their expectations upward. Without realizing it, decisions become based on what has just happened rather than what could happen next. When conditions shift, that same emotional momentum works in reverse. Declines introduce doubt, not just about the market, but about past decisions. Headlines magnify uncertainty by framing every movement as urgent or historic. The constant flow of information creates pressure to act, even when action is unnecessary. In these moments, patience feels irresponsible and doing nothing feels like losing control. What makes this shift so costly is that it disconnects decisions from purpose. Instead of asking whether a move supports long-term goals, people react to how the moment feels. Short-term discomfort becomes the enemy, even if tolerating it would produce better long-term results. The desire to regain emotional stability overrides strategy, and decisions are made to reduce stress rather than improve outcomes. This is how carefully built plans unravel, not through dramatic mistakes, but through small emotional adjustments that compound over time. Each reaction feels justified in isolation, yet together, they quietly erode progress in ways that are difficult to reverse. This is why even good portfolios fail. A portfolio can be diversified, professionally designed, and aligned with long-term goals, yet still produce disappointing results if behavior breaks down. Long-term averages assume perfect discipline. They assume you stay invested through downturns, continue contributing during volatility, and never let emotions override logic. In reality, very few people behave that way consistently, especially over decades. Now imagine a real-world scenario. Someone builds a solid retirement portfolio over many years. Then a sharp market downturn hits. Account values drop quickly. Even though the plan was designed for long-term growth, the emotional pain of watching balances fall feels unbearable. Fear takes control. They sell to stop the loss. Months later, the market recovers, but confidence is gone. They stay out too long. By the time they re-enter, much of the recovery is already over. That one emotional decision permanently lowers their long-term outcome. This is where the structure of a 10-year asset shield annuity with bonus becomes incredibly important. Not because it predicts markets, but because it removes the emotional triggers that cause bad decisions. Asset shield annuities are built so that there are no negative years. When markets decline, the account value does not decline with them. That single design feature changes behavior dramatically. When there is no visible loss, fear has nothing to react to. Panic selling simply does not happen. The bonus feature adds another layer of behavioral protection. Because the bonus increases the accumulation base up front, people start with a stronger foundation. That psychological boost matters. It creates early progress and reinforces patience. Instead of constantly worrying about timing, the focus shifts to consistency. Another powerful behavioral guardrail is locked-in gains. Once gains are credited inside an asset shield annuity, they are permanent. They cannot be taken away by future market downturns. This eliminates regret and second-guessing. There is no wondering whether you should have sold earlier or moved money somewhere else. Progress is not temporary. It is locked in. That certainty reduces emotional decision-making and builds confidence over time. Many people underestimate how damaging constant decision-making can be. Checking balances daily, reacting to every headline, tweaking strategies repeatedly. While this feels proactive, it often does more harm than good. The inability to day trade inside an asset shield annuity is actually a benefit for most people. It removes the temptation to act emotionally. Instead of relying on discipline, the structure does the work. When discipline fails, the plan still holds. Consider a very common situation that almost no one plans for properly. The market goes through a prolonged downturn. It does not crash overnight and recover quickly. Instead, it stays volatile for months or even years. News headlines are negative. Conversations are pessimistic. Every time someone checks their account, it feels uncomfortable. In moments like this, many people make what feels like a responsible decision. They pause contributions. They tell themselves they will restart once things feel safer. On the surface, that decision feels cautious. In reality, it is one of the most expensive mistakes an investor can make. When markets are down, prices are lower. Contributions made during downturns buy more future growth. Those dollars are positioned for recovery. By pausing contributions, the investor misses the very period that historically creates the strongest long-term results. Once markets recover and confidence returns, contributions restart, but now prices are higher and the opportunity is gone. The damage is permanent, even though it feels invisible at the time. Another version of this mistake happens when people constantly change strategies. Every few years, fear or frustration pushes them to abandon one plan and chase another. When markets are strong, they move toward growth. When markets are weak, they move toward safety. Each move feels logical in isolation, but together they prevent compounding from ever working. Compounding requires time, consistency, and patience. Constant change interrupts all three. Over decades, these decisions quietly erode wealth, far more than market downturns ever could. This is exactly the type of behavior asset shield annuities are designed to protect against. The purpose is not to outperform the market in exciting years. The purpose is to help people stay consistent through uncomfortable years. Because asset shield annuities smooth the experience and remove visible losses, people are far less likely to pause, panic, or abandon their strategy. When account values do not drop during downturns, uncertainty does not trigger the same emotional reactions. People stay invested because nothing feels broken. The goal here is not excitement, it is follow-through. Most retirement plans fail not because the math was wrong, but because the behavior did not hold. Asset shield annuities create an environment where long-term plans are easier to stick with. When fear is reduced, consistency increases. When consistency increases, outcomes improve. The cost of one bad decision can be enormous. Selling after a crash locks in losses. Missing a recovery means growth never returns. Pausing contributions removes future opportunity. Withdrawing too aggressively during uncertain periods permanently shrinks the base that future growth depends on. Each of these decisions may feel small in the moment, but their impact compounds over time. What is lost is not just money, it is time, momentum, and confidence. Asset shield annuities reduce the likelihood of these moments by removing volatility from the experience itself. This is a critical distinction. The goal is not just to protect numbers on a statement. The goal is to protect the person making decisions. When there are no negative years, there is no emotional pressure to act. When gains are locked in, there is no regret or second guessing. When the structure limits constant tinkering, behavior improves automatically. This is why a 10-year asset shield annuity with bonus should be viewed as a behavioral risk management tool, not just a financial product. It is designed for real people living real lives, not for perfect investors who never feel fear or uncertainty. It works even when discipline is imperfect, which is exactly when most people need help the most. Retirement planning is not just about formulas, projections, or averages. It is about psychology. A strategy that looks great on paper but collapses emotionally is not a good strategy. A strategy that quietly works because it supports good behavior often produces better long-term results, even if it feels less exciting. If this explanation helped you understand why investors so often underperform themselves, how small emotional decisions can quietly destroy good plans, and how a 10-year asset shield annuity with bonus can act as a behavioral guardrail, make sure to like this video, subscribe to the channel, and share it with someone who has ever felt stressed or uncertain during market volatility. More clear, practical education on annuities, retirement planning, and long-term wealth strategies is coming.